Hey, happy Friday, everyone. Welcome to Finance Friday. It's been a couple weeks since we've been here. Hope you had a nice time off.
You didn't do one last week?
No.
Why not?
Because it was a holiday.
It's still Friday.
Yeah, that's true.
It's called Finance Friday.
Anyway,
I thought you were dedicated to
if you've
this.
never watched this show before,
I apologize for her, everybody.
Yes, it's completely my fault. Jim has nothing to do with that. Hey, Artie. This is a show, if you've never watched us before, this is a show where we try to help you save and protect your money and try to help you grow as much as possible. We try to come up with tips. We do come up with tips. We don't try. We do come up with information that will change your relationship with your money. So, today, in light of this wonderful, play nice kids, in light of this wonderful market that we have going on, we've been having a lot of conversations with different people about how to handle this volatility because we've been so spoiled over the last few years. What? Are you just dying to say something over here?
Well, I may get 3 words out this whole half hour, I think. So I'm gonna talk for a second.
Jim's running the show this time.
Well, no, I seen Mick on the screen there.
Yes.
Makes me think that he should be doing this with you,
He
not
should
me.
be. Mick should be doing
Mick
this.
is the face
Mick
of
is
our sports and entertainment.
new addition to our team, and we are so happy to have him. And I think Mick will be here with me next week. I think I can
there's got to
confidently say
he's not going to drive in every Friday for this.
We can do Zoom.
Great. Really? So you could do like you on this side of the screen and him on the other?
Yeah.
And you guys can have a conversation, or you could really talk most of the time, and
Yes.
he could try to.
Can we get to what the topic is today?
We can get to the topic, but we're going to be able to get Mick into this,
Yes.
and I'll exit.
Yes.
Outstanding.
Okay, so go ahead.
Well, we're going to talk about volatility.
Yes.
And Amy had an interesting email earlier this week from somebody who is a little bit younger and not as familiar with the market.
He's probably watching this.
Great. And so
just started saving within the last few years. So that's why we said originally attention millennials. Because
but I don't think
they've
it's
barely
just
seen this kind of volatility.
I know, but I think a lot of people forgot about volatility because last year it was just a nice steady climb up with very little volatility. We actually posted in our weekly market update. It goes out on Facebook and
on
LinkedIn.
Mondays.
On Mondays.
Yep.
And one of the key points...
So if you want it, you can send us your email.
I forgot to look at the numbers, but do you remember what the numbers were? It was how many... Was it 2% move days last year? There was like...
Oh, like 5, wasn't it?
Yeah, like
very
not even.
low.
I don't even think there was that many.
Right.
And this year already we've had... I don't know what that number is. Tamara, could you pull that up? Actually, I have it here. No, I don't.
No,
maybe Tamara can pull it up.
She can pull it up and post it. But anyways, or they can check out our weekly commentary.
Yeah, but it's ridiculous how the low volatility last year versus this year, it's been through the roof. Or really, it's been since February, first week in February. January was a great month. February was crummy.
Which can be
March
scary.
Was crummy.
I mean, we mention it all the time, but I'll say it again, that now that the market is higher, there's also the psychology of it because we're seeing bigger point moves that, like you said, like 2% right now is about 500 points.
I actually did those numbers. So if we, on Monday, we're going to finish around 23,950 on the Dow. I'm not sure.
Today.
Yeah, today.
Yeah.
Also say 24,000. So a 530 point move on a level of 24,000 is a 2.25% move, which is a pretty big move for the day.
Right.
But if you just go back a couple years when the Dow was at 16,000,
right?
Because I had a very, very intelligent businessman make this point to me this week and said, I don't remember there being 600-point moves.
Right.
And I had to kind of put it in percentages. On dollars, you're right. There haven't in the past been many 600-point moves.
Right.
But when the Dow's at 16,000, a
320. 320 points is 2%. Oh, you're saying how much is 532 points when it was 16,000?
Yeah, 532 point on a $16,000 Dow is a 3.32% move. So more than another percent. So more than 50% more.
Right.
So,
or like I said, you could even compare it like, so 2% on 16,000 is only 300 points.
Right, 360.
And now it's 500 points. So it's just different. The psychology of it, looking at it, is just scarier. I mean, I know actually we just had that conversation with Marcy too. Like it's, am I doing something wrong here? Is there, that's a conversation I've been having with people. Hey, that's a conversation I've been having with people is, look, I'm not used to seeing my 401k go down like this. I'm not used to seeing my investments go down like this. Is there something wrong? Am I doing something wrong? Should I be doing something different? Those are the questions that we're getting right now because it's having everybody think about, wow, okay, we're now down 10% or 11% from the highs of this year. At the end of January, we set new highs. And we're now down about, like I said, 11%. So I mean, that's a normal correction, guys. So we don't want to say that it's okay and it's not uncomfortable. I know, Jim's back. Yay! That's exactly what I would say.
Not for long. I think I'm shrinking. I'm going to be like down here by the time it's over.
No, my seat's just higher than yours.
No, I don't think it was this low when we started.
I can slump. But anyway, so I think what you can do when you're looking at your statements is, first of all, look at how much equities or stock you actually have in your portfolio. So like the breakdown I was doing with the person on the phone yesterday, I think it was, we were looking at they're actually only like 65 to 70% in the market. How much in safe stuff do you have? Okay, and let's just take an easy example. Let's say it's 50-50 is your mix. And so if you have a 50-50 mix, in theory, you should be doing 50% of what the market is doing, right? I mean, when you try to think of simplistic ideas, this is very simplistic.
Yeah, because this is not exactly accurate, but
it's not. But
just
I'm
for
trying
discussion
to give
purposes.
someone that manages their stuff on their own.
Yeah.
Where's the baseline? There has to be somewhere to start, right? So
yeah,
if
that's
you've got 50%,
yes,
you should be doing 50% of what the market is doing. So if the market goes down today 3%, you should have went down about 1.5%. So that's your first gauge, first of all, when you're trying to think of risk and you're trying to think of, should I be doing something different? What am I doing wrong? Or is this normal for me? And then the second thing I would say is try to calculate how long you have until this actually has to matter to you. Wouldn't you say that's pretty important?
It is important, but if you're allocated properly anyway, and your time frame, you just mentioned time frame, if your time frame is long term, like if you're in your 40s and you're worried about this money for retirement, there's nothing to worry about. You shouldn't even be concerned with it. You shouldn't lose any sleep over the market. If anything, it's a buying opportunity.
If anything, you should be adding more. Yeah, so if you've got money on the sidelines, if anything, this is an opportunity to go in. If you're only 50% of the market, where is your other 50%? In safe stuff, so in like bonds. That's a great question. In bonds, in currencies, in gold.
Cash.
So in cash, in money markets, in other things besides stock.
Yeah, you don't want all your assets to correlate together. Like stocks in general.
Explain what correlation means.
Correlation means just moving together. If the market's up and you're in stock, more than likely you're going to be up. Like you could own. It's funny. Like if the S&P 500 is up 2%, most of my board of individual equities are all green as well. And it doesn't mean that stock had a good day. It's just the market's up.
Right.
So when things are green, the market goes green. But when the market goes red, you don't want to be in all stock, because if you're all in stock and the market goes red, you're going to lose. It all
goes down.
Yeah. So you want to be in asset classes that don't move exactly with the market. You want things that move differently.
That can be. So there's two ways to look at diversification. Hey, Sally, I just talked to our guy, and I got to tell you about that. Which we could talk about that on this too.
No, I don't think so.
It's kind of crazy.
It's pretty crazy.
But the diversification piece, right? So there's being diversified, there's owning different asset classes. Obviously, this is boring stuff. This is like investment 101. But there's owning cash, there's owning bonds, there's owning stocks, whatever. But there's also diversification within your stock. So you could own international stock. This is something you need to take a look at when you're looking at your portfolios, and you're looking at your 401k.
And you probably should. I think emerging markets now.
Emerging markets is another one.
Is probably
international, emerging market, U.S. markets. And this is usually just in the name of your funds.
And the international markets, most portfolios are underweight international and definitely underweight emerging, because emerging is it doesn't have a tendency. It is more aggressive, certainly, because they're smaller, underdeveloped countries that have a lot of room to grow, but they also have a lot of room to go down, because they're a lot more risky than the U.S. S&P 500. But if you're looking to get some money to work, that's a place to potentially consider. If you can change the
psychology of, okay, if I have a lot of different asset classes and I have a longer term time frame, change your psychology from, oh my gosh, what am I doing wrong? Oh my gosh, what's going on in the market? How am I underperforming? And start seeing the opportunities and say, okay, maybe this is an opportunity where I take my money in cash and I put it in emerging. And you further diversify yourself, because then in the long run, man, will your later self thank you that you did something about it. Don't just sit on the sidelines, especially if you're young. Especially if you're, what would you say, 50 and under?
For sure.
50 and under, young. And so we said attention millennials, but really that's like up through age 36. But really it's 50 and under is you should be trying to take advantage of opportunities if you don't have someone that's doing it for you, because this is something that we do. Hey, Joni. This is something that we do automatically, but if you're doing this on your own, try to take advantage of those opportunities instead of sitting back and saying, what have I been doing wrong? Should I be getting out? You know, if you've got time, man, take advantage. With the climate of our government, is there a country you should stay away from? It's a great question, too. For those of you just joined, we just had several people just join. We're talking about what to do in the market volatility, so especially if you're younger, especially if you're thinking of putting cash to work or what to do with it. We're trying to talk about where to take advantage of opportunities and how you should be looking at your portfolio, especially your retirement accounts with your employers, because that's where a lot of the questions are coming from. But Marcy just asked a question.
Yeah.
So with the climate of the government, is there a country that we should stay away from?
And I'll just say, we don't typically go and invest in one country. We track Germany, we track Switzerland, we track all of Europe. And emerging. So
the SX5E is the European index.
Yeah, I can't say we don't really buy individual stocks on.
No, but she's talking about like in her 401k, I think, like when they're looking at their 401k portfolios. The good thing about that for you is that when you're buying an international portfolio, what you can do is you can look at the top 10 countries. So you can break out, you can just click on your investment, right? And it'll break out a sheet, a fact sheet, what we call them, on your fund. And you can look at the geographic areas, and it'll give you the top 10 geographic areas. Even the top position is usually like less than 3% in any one country. So if you're investing in a diversified portfolio...
In any one country?
Usually.
Huh.
Like break out any international fund. There's usually not a huge concentration in any one country. Maybe U.S., but I'm talking about any of the individual smaller countries. There's not really going to be more than 3% in any one country. So you, LOL.
Yeah, I don't think that's right.
Okay, so we have another debate.
Well, just pull any international fund up, and I think you're going to have like 16% in, Great Britain and 12% in Germany, and like they top heavy the big ones, and then you'll get like
a bunch of little ones. I thought we were talking about like emerging markets. Like, is there any
countries? I'm sorry.
Is there any small countries we should stay away from?
Oh,
I thought.
All right, so I just misunderstood. She's never wrong. Sorry.
I was laughing at Jim's response. Yes, I get used to Jim's responses, the blank stares.
What about my response? Why was she laughing at my response?
Because you're like, like you're just making all kinds of crazy faces and being uncertain. But anyway, so is there any countries you should stay away from? At this point, if you're investing in the diversified portfolios, like especially in your retirement accounts, I wouldn't say stay away from any one fund because of, okay, so actually if we're going to talk about it, I don't think it has much to do necessarily with our administration right now, but Amy is always right. That's true, Mick. But as far as the countries that are in trouble, obviously you've heard Greece year after year after year. We talk about Greece, Italy, Portugal. Yep, Greece, Italy, Portugal. I'm missing one.
I'm not sure we understood her question because...
So those are the countries that you definitely want to look out to stay away from.
Yeah, which you would anyway. There's no way you would just invest in those countries unless there's something
Let's talk about that for a second. So she mentioned, like, I'm sure you're thinking about the tariffs, right? So let's talk about that for a second. So China has I believe, and somebody can Google this for me, but I believe China's GDP is like 10.7 trillion, something around there. The tariffs that we impose on them, that we have imposed already, is $50 billion.
Well, he brought up another $100 billion.
I know, but that is not done yet.
50 is not done yet. Nothing's done yet. They're just talking.
Well, I think the 50 is signed. Anyway, doesn't matter. 50 billion, 100 billion. On 10 or 11 trillion thousand dollars?
$1,000,000?
$1,000,000. I was reading.
10 bazillion.
If this
10 bazillion dollars.
See, I keep having texts coming through. I wish that wouldn't happen. If that we're looking at the trillion, 10, 11 trillion.
Trillion thousand.
No, now you've got me all messed up.
It's a small percentage
small number.
of their GDP is what she's trying to say.
So it's not like this huge threat.
It's just people flexing. Trump is flexing. China doesn't want to be pushed around. They throw it back. They're just negotiating. Nothing's done yet.
Right. But we did talk to, Mick and I actually just met with a gentleman that said he has a client, it was a CPA, he has a client that all he does is sell aluminum for cans. Was it, Mick? Or am I making this up?
You mean like...
I think it was aluminum for cans. Campbell
like
soup cans?
You put your soda cans in the thing, you get a nickel back, like in Michigan?
No.
That kind
he
of... He
makes
does that?
the cans.
Oh, he makes the cans.
Which actually, Hess, if he's still on, I think his company does something like that too. And they're really going to get hit from tariffs. If their personal company was like $400,000 on the tariff. So there are some companies that if you're isolated to one business, you will be affected by these tariffs, obviously. But for the larger businesses that are in thousands of different things, this isn't going to affect the broad spectrum economy, but it will affect some smaller businesses that produce only one item that may have a tariff on there. So for those of you just joining, we're talking about the overall market. We just got talking about the tariffs actually, but we're talking about the volatility in the market, what should you be looking at in your retirement portfolios? Should you be doing anything different? Is there any opportunity?
So I think one thing that people might want to consider is to make sure you always have some cash on hand, because we bought today.
Yeah.
We ended up buying cloud computing, a focus in cloud computing today. So it was an ETF. What we did was we took some of a handful, it was more than a handful, it was probably 30, 40 clients today that own the market, own the general market that we didn't average down for earlier in the week. And on a day like this where the market's down to over 2%, we ended up buying an ETF on cloud computing with 10% of the available cash they had. So to make it simple,
make sure you have cash on hand.
So if they had $10,000 in cash in their account, say the account's $100,000, if they had $10,000, we used $1,000 of it to buy today on this.
So it's not like you're going all in and you're putting a whole bunch of money.
Yeah, you never want to do that
slowly, because you never know where the bottom is. But Hess said they make 12-ounce cans. So will you guys be affected by the tariffs? I'm really curious about that. I've been talking to a lot of business owners, and the majority are not affected, but if you're really in one isolated business, you may be affected. Actually, Ryan, Bradley, you guys may be affected too. I'd be curious on that. But anyway, so if you can answer in the comments, that would be great. But buying, so if you have some cash on hand, that's definitely a great way to combat volatility and nightmares of volatility, of thinking about what's going on in the market, what should I be doing. If you just know you're buying low, we don't know how low this will go, but if you just know you're buying low over time, you will win. Because if you're buying on the way down and not buying at all-time highs, over time, that strategy pays off. You're buying on the dips. That's what everybody tries to do, buy low, sell high. It sounds way easier said than done.
Yep.
So that's what we were doing. We were taking some money out of cash and putting it to work today. So in addition to the reallocating we talked about before, remember I talked about maybe taking some money out of the safer stuff, taking advantage of this opportunity if there is no cash. Take some out of the safer stuff. Marcy asked earlier, If it's not in the market, we are talking about 50% in the market. If it's not in the market, where is it? And so we mentioned bonds, cash, currencies, gold. It can be in a lot of things, just anything that isn't stock. And you can take some of that and allocate it to equities, either international, emerging, large cap stock, small cap stock. Within stock, just make sure you're super diversified too. That definitely matters. Don't just be in stocks and bonds. And then you got to take advantage on the volatility. Otherwise, you're right. You will just write it down and then you'll write it back up someday. But you miss the... those are your two choices, really. That's putting it pretty simple. You either... Well, there's three choices. There's three. I might come up with a fourth.
3 choices to place money? Is that what you're talking about?
3 choices of what you can do when the market is doing what it's doing. You can do nothing and write it out.
And you could kind of do that if you're allocated properly. At least that's what every money manager in the country will tell you when they're not doing anything for you.
You're diversified. You're fine.
Yeah. Just write it out. You're fine. That's what they'll tell you. In big events, though, we'll take action. And they should, too, but they won't. But you should. If something serious is happening, a 600-point down day...
I'll answer that question in a second.
A 600-point down day is not serious. This is nothing. I mean, yesterday we were up...
Right.
Well, it was only up 200, but I think we had 4 straight days.
The day before it was up again.
There was was it Wednesday where we were down 570 at the open?
Right.
No, not at the open. When I woke up that morning, the futures were down 570.
Right.
And we ended up being up for the day.
Like 400 points.
Yeah, it was like an
No, it was like 290.
Yeah, I think it was like an 800-point swing from high to low to high. So,
the market is just driving us nuts at work. I bet you got a lot of people there that talk about all kinds of things in the market. I'd love to be a fly on the wall on that. But I said 3 things.
What does he work for?
Bowhouse. So there's 3 things that you can do. You can write it out, which is what most people will tell you to do. You can go to cash. You can freak out and go to cash, and then you got to be right twice. You got to know when to get out and then know when to get back in, which doesn't work for many people. And then the third is to just buy a little bit every time the market goes down, and you know you're buying low. Yeah, it's that simple.
Ryan, tell everybody to relax.
Yeah.
I mean, it's a 401k. Tell everybody to just relax. Unless they're retiring in the next 3 or 6 months, they shouldn't even concern themselves with it. Because the beauty of a 401k is you want the market to go down this year because you're buying every 2 weeks. You're buying more and you're buying more.
That's a great point, honey.
You want the market to go down.
He isn't just a pretty face. I'm glad you made that point. Say it again.
In a 401k, if your time frame is long, you want the market to go down because you're buying every 2 weeks.
Right.
Why would you want it to go up now? Because eventually it's probably going to pull back. So if you
You're
have
adding
time,
more when the market goes down.
Absolutely. So tell everyone at the boathouse to chill. Jesus.
So Ryan said, so they're one of those companies that are worldwide, international, so they're not going to be hit as bad by the tariffs because they make more than one thing. But so that was one of the examples we were saying. But in his specific plant, they just make the cans. And yes, America will still absolutely buy beer and drink beer. So I don't see that as a problem. Yeah. That's the other thing about the tariffs. That's a great point too. Is when you think of $50 billion in tariffs allocated across, how many in sales are in the beer market alone? A case of beer is going to go up like 6 cents. Like it's not, and you talk about like a Campbell's soup can, like Campbell's soup might go up 5 cents. Like you're not talking about large impacts. Well, I don't know the exact numbers, but I've now heard many people speak on it, and I've done a lot of research on it, and that's the consensus, is that it's not going to affect overall prices that much. Electronics was one that would affect quite a bit, but that's already a luxury item. If you're buying electronics, you should be able to afford it.
This whole discussion is kind of, it's
you are
necessary.
The expert, especially after watching this.
Who said they're the expert?
He said Ryan.
Which Ryan? You're talking to 2 different Ryans.
I know, 2 Ryans. Ryan Bradley.
Okay. The tariffs. This is all going to be old news before too long. I don't think this is a game changer. Well, they need us way more than we need them.
No, I know that.
For sure. We're the richest country in the world. We're getting killed in the trade deal, the current trade deal. We're just trying to negotiate a better deal. I'm not worried about it. This market movement is an opportunity.
The one thing that they did say, though,
we should have
today,
bought, more people should have bought today,
is that the way that the negotiations are going, it does get drug out, though, because now every time, companies and countries get 30 days to respond. I forget the exact timeline that they said, but it's getting drug out because they have a certain amount of time to respond when it's official. So
it's
maybe
like 180 days.
Something like that.
Yeah.
So, it could get drug on for months.
So what? I don't care. Again, time frame. Who cares?
She never calls me Ryan. I know I don't. I didn't even realize it. Did I say Hess? Oh, I thought I said Ryan.
I think you said Hess earlier.
I think I might have.
Anyway. All right, let's wrap this up.
So follow us on Twitter at Nova Wealth Management, MGMT, it's abbreviated, or our personal individual Twitters at Novakovic Amy or at Jim Novakovic. We have a podcast that actually I just did some really cool interviews when we were out in LA. I interviewed on the red carpet of a bunch of business owners, really big hitters in the business world. Are we ever going
to get that on the web?
They're on the podcast. I know, we're working on it. Well, it's going to be on our podcast, and then it'll be on our website, novawealthmanagement.com. But the podcast is The Nova Wealth Show, and it's on iTunes. But it is also going to be on our website. So check out those interviews for some really great business tips and just listening to these awesome business owners. So like Ugg Boots, Priceline. Anyway, these guys were amazing. Also, what else do we have? Oh, Instagram. We're just building Instagram. We just started it, so go ahead and follow us on Instagram. That would be great.
And the greatest sports entertainment director in the history of all sports and entertainment, Mick McClendon,
will be here next week. Dun, dun, dun.
On this show.
Oh, Marcy, you had a question. She had a question that if I'm 40, what percentage should I have in the market? That was a really great question, so I'm glad a lot of people stayed on because I'm going to answer that now. If you're 40, what percentage should you have in the market?
You asking me?
Well, I know what I would say, but I'm curious
I know
what
you'll probably disagree with me.
Go ahead.
For somebody who's 40, are you going to work for 20 more years? If so, I wouldn't have any more than 10% in fixed.
Yeah, it's about how long you're going to work, right? So I know I actually just talked 2 days ago to a 70-year-old that says, I'm working until I die. I enjoy working. I'm going to work. I'm going to keep running my business. So it's not necessarily your age. It's about how long you have until you actually retire and you actually stop working. So if you say I'm 40 versus I have 30 years to retire or 20 years to retirement, that's kind of a difference in my eyes.
20 and 30? It's both long term. It's no difference to me. Is that what you were saying?
Yeah, I would disagree a little bit. I would tweak it by 5%. I mean, it's not a huge deal.
Oh! And we're out.
No, we're still there.
That was you, I think.
It was me. Rotate your phone.
Stick it. Are we still on?
Oh, yeah. There we go.
Are we on? No, not? No? Oh.
Yep, yeah.
Is everyone still there?
Sorry,
Somebody,
guys.
Hi, John.
Where's my seat?
Are we still there?
Yes.
Actually, you were better over there. You were coming in a little better. Go back to there.
It's tilted, but that's okay. We're on.
Are we?
Stuff.
Yeah, we're good.
We're good.
All right.
So I would say an 80-20 mix for someone that has 20 years to retirement, and I wouldn't necessarily say the 20% should be all in fixed. This is bothering me. I would say that it should just be in other things besides the market. So have a little gold, have a little currencies, just diversify yourself in other things. Have a little in money markets. So 80-20 mix, if you've got 20 years to retirement. Jim says different. Jerry Springer called, calm down. I know, it gets intense. Whew, finance.
You know what I heard about Jerry Springer? There was
Jim loves to get off topic for giving me hell about how much I talk.
People are going to care about this.
Jerry Springer.
Everyone knows Jerry Springer.
Okay.
People are going to care about what I'm about to say.
Great. Say it.
I heard, I forget what show it was. It was on the radio. Doug Stanhope. I think he's a comedian.
Okay.
People know who Doug Stanhope is.
I don't.
I think I'm saying the last name right. Anyway, before he became famous.
Before who became famous? Jerry Springer?
Doug Stanhope.
Oh, yeah, because he's so famous.
No, if you saw him, he's a comedian. If you saw him, you would know. Somebody please help me and tell me you know who that is. Somebody Google it and say, oh yeah, see, I see a smiley face. Somebody hit a smiley face. Anyway,
he
was
before
hired.
He was so famous.
He was hired to go on to Jerry Springer and say it was like one of your baby mama things, and his character was supposed to go on and
so they're actors.
Yeah.
I always thought that.
Yeah.
Did we not know that, though? That wasn't a public thing?
I don't know. I think people were... I mean, we
so
always
it's kind
wondered
of like,
that
so Jerry
we couldn't
Springer
be this...
is kind of like the Inquirer.
Yeah. Yeah, because everyone knows that's not real, but I don't think I knew...
Am I making that up?
Well, I guess it was never confirmed that anyone...
He knew that.
See, Ryan knows who he is?
There's no hope for you, Artie. Yes, that is very interesting.
Isn't that interesting?
Everybody wanted to know
Everybody wanted to know. Thank you.
Tamara's no idea.
Doug Stamhope. I'm probably not saying it right. Come on, Tamara.
Anyway.
Wait, I got one last funny story. One last funny story. So, one last funny thing. So, Ed Woolman, who's...
I hope Mick is still on, because this is what you're up against next week, right?
Ed Woolman, who is an attorney that we work with out of Naples, who's outstanding.
Somebody from your wonderful hometown was on Jerry Springer, by the way, Marcy just said.
From Wycliffe?
Two men walk into a bar. From Wycliffe.
That doesn't surprise me. So Ed Woolman sent Amy flowers earlier this week.
Yes, he did. Thank you, Ed. I love Ed Woolman.
Yeah, he's the best.
He was on our Finance Friday a few weeks back. If you didn't get to catch that one, he's an estate planning attorney. Watch that one.
And how did it go?
He gave me tulips for Tulip Tuesday. And Tamara, how did it go down?
No, you said... I
said, I love when I get flowers.
Yeah, and I said, oh, no, here it is. And then I said, I was going to get you flowers earlier this week. And Tamara was walking by and she goes, I don't think I've ever seen you get Amy flowers. And I'm like, no one asked you, Tamara.
Yeah.
It was a kind of a funny exchange.
It was a funny exchange.
But no one did ask you, Tamara. I've gotten her flowers before.
And still, I have no flowers other than Ed's flowers. Thank you so much.
That was so very, very thoughtful.
That was very kind. So what did we talk about today? So there's 3 things that you can do.
No, we don't need to recap the whole thing.
Yes, we do. Great story. Thanks. Yeah, I thought
it was
a pretty good story.
Right?
So you can wait it out, you can go to cash, or you can buy a little bit, or you can reallocate. If you don't have any cash to buy with, you can take some of your safe stuff, so anything that's not stock, and just put a little bit in the market. Get flowers for your wife. Yes. Ryan.
Shut up, Ryan. Oh, that's Ryan Bradley. I thought that was Hess. Sorry, Ryan Bradley. I can tell Hess to shut up.
I know.
Although you shouldn't say that.
That's rude.
We tell our kids not to say that.
Yes, we shouldn't.
Yeah.
And so you need not worry. You need not do something different other than take action to better your portfolio. But please don't panic, especially if you have 20 years to retirement.
Yeah, relax.
Even 10 years to retirement, I would say. 10 years or more is my cutoff.
And if you're doing a 401k.
We'll do some different things. We should probably talk about that. We should do a Finance Friday on that. If you have less than 10 years to retirement, what should we be doing in this market?
Well, we're going to disagree. You said 20% if you have a 20-year time frame.
I do say 20%
That's so
outside of stock.
ridiculous. What are you, nuts?
Oh my gosh. And you say 10%. It's not that much different. I'm just saying diversify. I'm not saying have no risk in the 20%, but I'm saying diversify into currencies, real estate, gold. They're all volatile, but have something outside of
just
stock.
Just sit there. Currencies and gold.
I expect to see flowers the next time you're both here.
I'll give her I'm never going to be on the show again, so Mick is taking over next week.
I do not care about retirement. Yeah, and we should talk about that too, because Ryan, you invest for like either kids' college or you invest for like just a...
Oh, that's Ryan Bradley. I bought for your kids today? Or earlier in the week. I did.
Yeah.
Yes, I did.
We call it the kids account.
The kids account. It's the short name
Mick,
on the account.
I'm scared.
Mick, you should be scared.
We're going to see how this goes next week with me and Mick. I think we're just gonna kill it. Yeah.
We'll see.
Anyway, everybody.
Actually, what we should do, is have Mick and I do it, and you go.
I love that idea.
Once in a while.
So I'm out. I love that idea. And so we'll talk about next week we're going to talk about what to do with your tax return money.
Oh yeah.
By the way, so that's next week because it's tax week. So next week we're going to talk about tax return money, and then after that we'll do a live on what to do if you're less than 10 years from retirement, and we should also do if your investment goal is just less than 10 years because like Ryan said,
Marcy, text me who was on Jerry Springer from Wycliffe.
Everybody have an awesome weekend, and we'll see you next week.
Bye.
I might. Not.